Thank you. Okay, folks. Get settled in, please. I like yellow. I don't even care about schools anymore. I don't like Stanford, but I like the red. So I like the red. Come on in, folks. Get settled in. Morning, how are you? Okay. So, that's a whole pile. Okay. Try to keep your pile separate because your pile will already be in alphabetical for your grouping because I said A through J. So if you keep it, it'll make your life a little easier. Okay, folks, get settled in, please. If you're checking,
Okay, that's not A through J. Yes, one después de J.
if you're checking with the person next to you, don't. Okay? I'm not going to go over the quiz, but let me explain what the next step in the process is. I will start grading the quizzes at precisely 12 o'clock. By precisely, that's how long it takes me to get back to my office. I'll keep grading till I'm done. And when I'm done, I will let you know that the quizzes are done, and I will also send you the solutions with the grading template, and I will put your quizzes out on the 9th floor of KMEC with the finance, outside of the front door. I'll send you directions on where to look, in alphabetical stacks face down. Now, you can see why I asked you to write your name on the back, because it'll be alphabetically face down. Don't browse, please. This isn't Barnes & Noble, so just take your quiz out of the pile, move on, right? You don't care about, you should not care about what the rest of the class, I'll send you a distribution. If you care about what the rest of the class is, I'll send you a distribution, the 10th percentile, 25th percentile, 50th, whatever statistics you want to make you feel whole, but just let it go, right? Take your quiz and move on. So you will get that email sometime probably late tomorrow night. I would have normally sent it to you tomorrow morning, but unfortunately I have to be in Boston tomorrow, so I can't return the quizzes until I get back from Boston. So when I get back, I'll probably get in around 9 o'clock at night. I'll put the quizzes out. And if you want to come at midnight and pick it up, fine. But if you want to pick it up the next day, it'll still be there. Don't worry, the grades don't change overnight, so just leave them. I said I wouldn't cover the quiz, but I just want to hit a couple of points because I think it re-emphasizes things I want to say. First one, the multiple choice questions. I think I was kind. Because in most of the questions, there was one obvious answer and 4 not so obvious wrong answers. But no, I was... The only question where I think you might have run into some issues is the 4th question about Facebook, right? And what does the question ask? Give me the wording of the question. As a diversified investor, so already through done, then say, which of the following risks would you bring into your discount rate, right? So go back, before you look at that question, what did we say about the kind of risk you bring into your discount rate if you're a diversified investor? What kind of risk? Risk that you cannot diversify away. Market risk. And what's the essence of market risk? It cuts across most firms at the same time. Almost by definition, it has to be macroeconomic. So you're saying, but what, Mark Zuckerberg leaves Facebook. In fact, you could see the mixed feelings people have about Mark Zuckerberg because people weren't sure whether it was leaving or staying was the bigger risk, right? Okay. He said it'll affect the stock price. Absolutely. It'll affect the stock price, but it's not risk you will bring into your discount rate. You're saying, where will I show it? You've got cash flows in the numerator. You can do all kinds of neat stuff there. The discount rate is a vehicle for carrying only macro risks. I gave you the example of Nike, right? Remember the Zion Williamson sprains his ankle because the shoe blows out, Nike loses $2 billion. Over the weekend, we had another big example of firm-specific risk. Do you know what that is? The Boeing today was, at least overnight, was down 9%. I don't know how much. 9% is, no, in terms of magnitude, that's what, $7, $8, $9 billion because of the Ethiopian airline crash. That's the second crash with the 737 MAX, which is their best-selling aircraft. The price will be affected, but it's not something you show in the discount rate again. It's a cash flow effect. And it's tough to let go of because you want to bring all... I describe the discount rate as a receptacle for all your hopes and fears. Because you want to put everything in there. The discount rate was not meant for that. It's meant for macroeconomic risk exposure. It doesn't mean you don't care about the other risks, but there are other places you can bring them in. So, as I said, you'll get the quizzes, you'll get the solutions, check them out, and remember, the worst of your 3 quizzes goes away. So the good news if you've done badly is this was your freebie. The bad news is this was your freebie. Now it's gone. There are no more freebies left. So if you did well, chill. It's not you haven't climbed Mount Everest yet. It's just the first quiz. It's only 10%. So keep it in perspective. So let's continue with where we left off. I took you through that fairly torturous process of estimating a bottom-up beta for Disney, right? I broke it down to businesses. I got a beta for each business. I took a weighted average. I came up with the beta for Disney as a company, and I gave you betas and cost of equities for each division. But I tried to explain why I went through that process, because not only do I get a better cost of equity for Disney as a company, I now have a cost of equity for each of its businesses. Now let me use that same approach on Vale. Much less interesting company in terms of what it does, right? There are no theme parks and movies. This is just old-fashioned mining and logistics. Vale broke themselves down into 4 businesses in 2013. One was metals and mining, which is everything other than iron ore that they do. The second is iron ore. The third is fertilizers. And the fourth is logistics. I won't torture you by going through the entire mechanics again, but I went and found publicly traded companies in each space. And notice with every space I've used global companies to get my betas. You say, why don't you just stay with Brazilian companies? Unlike the US, you don't have as many companies going for you, so I went global. Based on my assessment, those are my unlevered betas. The fourth column is the unlevered betas for the 4 businesses. Then I looked up the revenues that Vale reported for each business, applied that multiple of revenues to come up with an estimated value for each business. And based on those estimated values, the weights I get for each of the businesses is in the last column. Vale is predominantly an iron ore mining company, but it has pieces in other businesses. Incidentally, about 2 years after I did this, Vale sold their logistics business. Now, if they'd hired you to value the logistics business, do you see how this table would have come in useful? To value the logistics business, you'd use the beta for the logistics business and a cost of equity for the logistics business, not the beta and the cost of equity for the overall company. So the breakdown for Vale's businesses gives me an unlevered beta for Vale, weighted average of 0.844. Remember for Disney, I went through this process of allocating debt across the businesses? Partly because I said the movie business and the theme park business are very different. They probably don't carry the same debt. I thought about doing the same thing for Vale, but they're all heavy capital investment businesses, all four. So after a while I said, why am I wasting my time trying to slice something that doesn't have to be sliced? I gave them all the same debt to equity ratio. Notice by now, the question you're asked is, am I allowed to do that? In corporate finance, what's the answer? You're allowed to do whatever you want if you can explain why you're doing what you're doing. This is not a discipline with rules, it's a discipline with principles. So if you can go back to first principles and say, hey, based on what I see in this company, I'm going to give every division the same debt to equity. I'm okay with it as long as you're okay with it and you've thought through it. I end up with the cost of equity for each business. All of these costs of equities are computed in US dollar terms. Why did I choose to do that? See if you remember. Vale is a Brazilian company. Why am I doing everything in US dollars? It's a Brazilian mining company. And there's a significance there. Commodity companies around the world, even if they're incorporated and traded locally, will often report their numbers in US dollars. Why? Because they sell into a dollar market. Oil companies around the world report their numbers in US dollars. So it's true I could have done this analysis in reais, but because everything was in dollars, I'm going to do my analysis in dollars because, why go back and forth to another currency if in fact my numbers are going to be in dollars? So my cost of equity for Vale, based on the bottom-up beta approach, is 11.23% in US dollar terms. Let's say I do this, and I present this to Vale's CFO, who actually happened to go through this class in 1993. And he said, no, we don't do things in dollars anymore. We do things in nominal reais. First, give me a sense of direction. If I wanted a cost of equity nominal reais, would it be higher than 11.23% or lower than 11.23%? Why? It has to be only inflation. Don't say country risk, because country risk is going to be there whether I do it in dollars or reais or pesos. It is going to be because of inflation. So I'm going to give you a quick and a dirty trick, which we've used before in the context of risk-free rates, to convert my dollar cost of equity into real cost of equity. It'll take you just 1 minute. You can convert to any currency. To make this conversion, I need two numbers. I need the expected inflation rate in reais and the expected inflation rate in dollars. Notice the word I used, expected inflation rate. Unfortunately, in much of the world, you will get just actual inflation rates in the past, and you have to decide whether that inflation rate is reasonable or not. The IMF does have forecasts of inflation by country. I don't know how much to trust it, but there are forecasts of inflation. The US is the only country where you can get a market-determined measure of expected inflation. How? It's two numbers I can look up in the US. I'll give you an additional clue. They're in the bond market. Two numbers, the difference between which will be the expected inflation. The T-bond rate and the TIPS rate. Remember the TIPS rate we said was a real risk-free rate? The T-bond rate is a norm. The difference between those two is the expected inflation. So if you're in the US, don't waste your time asking economists what's the market-driven number has money behind it. People actually put their money behind their word. Might as well take that. So in this case, if I have a 9% inflation rate in Brazil and a 2% inflation rate in the US, my 11.23% will become 18.87%. Incidentally, there's a shortcut that people use all the time, which is to take the difference in inflation, which is 7% there, and add it to your dollar cost. If you're in a hurry, you can do that, but you can see already as you get to higher and higher numbers for inflation, why you might want to do it right, which is it's a compounded effect. You've got to capture that compounded effect. If I wanted to do things in real terms, what do I need to do? Not real terms, so real terms. What do I have to do? The 11.23% is a dollar cost of capital, right? If I want to do things in real terms, what do I have to do? I have to take out the inflation in US dollars. And if that's 2%, if you're in a hurry, you can subtract out the 2% to get to 9.23%. But you can do exactly what I did here. So you can move between currencies, between nominal and real. You've got a mechanism for being able to move across currencies. Any questions? What if I asked you to do it in Venezuelan Bolivar? You should refuse to. on principle. And here's what will happen. What will the inflation rate be? Probably 500,000%. The rest of the process becomes kind of no point. It's a big, big, big number in Venezuela. Now, are you surprised that Venezuelan companies have stopped investing? How can you invest? It's not just that it's a high number, but it's an unstable number, right? It could be 500,000%, it could be 5 million%, it could be 50,000%. It'll kill all investment in the Caribbean. It basically will not make it. So let's complete the process here. Tata Motors. I put them in one business. I had second thoughts about this, and I'll tell you what my second thoughts were. I put them in the automobile business. I gave them the beta for global automobile companies, which was 0.8601. Again, notice I've gone global, not Indian automobile companies, partly because of sample size and partly because they bought Jaguar Land Rover, so they're a global player. I used the debt to equity ratio for Tata Motors, which is 41.41%, and the tax rate in India, which is 32.45%. Levered beta 1.10, and rupee terms, my cost of equity for Tata Motors is the rupee risk-free rate, where I took out the Indian government default spread, 6.57%, plus the bottom of beta times an equity risk premium. That equity risk premium reflects where Tata Motors does business. It's not that it's an Indian company. I'll tell you what my second thoughts were. This is an automobile beta, right? Jaguar Land Rover is not just an automobile company, it's a luxury automobile company. You're saying, so what? Remember we talked about discretionary, non-discretionary? If I showed you Volkswagen and Ferrari, or Volkswagen and BMW, without looking at the numbers, which one would you expect to have a higher beta? I would expect the luxury automakers to have a higher beta. It's a little more discretionary. I considered breaking Tata Motors down into luxury auto and mass market auto. And then I said, I'm too lazy, I'm just going to move on. So if you come to that same fork in the road, don't be as lazy as I was. Maybe you can break it down and say 20 luxury auto companies, but you'd expect the luxury auto companies to have a higher beta. But that's my cost of equity for Tata Motors. Baidu is in the search engine business, but the search engine is not a business. You make money because people use your search engine. It's an advertising company, just like Google is an online advertising company. I use the beta for online advertising companies, which is 1.30, reflecting the fact that many are young, they're changing, they're risky, technology is shifting. I use the debt to equity ratio and the tax rate for Baidu. Notice that every one of them, the unlevered beta comes from the sector, but your tax rate and your debt of equity are your choices to make. You can choose to have no debt, lots of debt, and the levered beta that I come up with for Baidu is 1.36. I did everything in local currency terms, so my risk-free rate is a renminbi risk-free rate, beta 1.356, and the equity risk premium for Baidu is the Chinese equity risk premium because it gets all of its revenues in China. I've never talked to anybody who's ever used Baidu outside China. It is very much a Chinese search engine with the Chinese market. And then I got to Deutsche Bank. So I've covered 4 companies so far, right? Let's do the last 2. So with Deutsche, I broke them down into 2 businesses. One is banking and the other is investment banking. And the third should be screwing up, but I didn't know how to classify that as a business, right? It's got a big side business going on. Right? Like how can we screw up every one of our regular businesses? Right? So banking and investment banking. I did exactly what I did for Disney. I went and found publicly traded banks. In this case, I stayed regional, partly because the risk in banks is very heavily driven by regulation, and there are regulatory differences by region. So I used European diversified banks, 84. For investment banks, I ran into a bit of a problem, and I tried to stay Europe focused. In Europe, most investment banks are parts of commercial banks. They're not separate and independently traded. So here I went global. Again, the question is, am I allowed to do that? What's the answer? You're allowed to do whatever you want as long as you can explain why you're doing what you're doing. So in this case, I get betas for the 2 businesses. And I take a weighted average. Notice I skipped a step here that I did for both Disney and Vale. What's the skip I seem to have stepped? In Disney, I got the businesses, I got the betas for the businesses, but before I weighted them, what did I do? I unlevered the beta, and then I re-levered it back up, right? Here I seem to be skipping the unlevering and the re-levering. Why is that? It's a bank. No, but what is it about a bank that makes me a little think of debt a little differently? If you think about a traditional company, debt is a source of capital. Debt to a bank is like steel to an automobile company. Because think of an old-fashioned bank. What do? You have deposits and borrowings that you pay 4% on. You take that money, you lend it out at 5%, you make money on the spread. Debt to a bank is no longer a source of capital. You're going to see this play out in lots of different ways. I will not even bother computing a cost of capital for a bank. In fact, if anybody talks to you about the cost of capital bank, shut them down. Because really, banks have equity as their capital. That's their prime capital. So you can do a cost of equity, but you can't do a cost of capital. You can value the equity in a bank, but you can't value the overall bank. So I'm cutting this off at the pass, saying, okay, if you're an investor, if you're a bank, your beta is going to be a weighted average. I'm implicitly assuming that all banks have the same exposure to that leverage risk that comes from the fact that equity is a small slice of the company. And there are ways we might want to bring this in. I've increasingly started looking at regulatory capital ratios as a proxy for how risky is equity, because Deutsche, especially today, is an undercapitalized bank. If I just take the average bank for the beta for other banks and apply it to Deutsche, I'm probably underestimating its risk. But it's not a debt to equity problem, it's a regulatory capital problem. So if you want to control for risk, that might be what you want to look at. So the cost of equity that I have in euro terms for Deutsche is 8.28% for commercial banking and 9.44% for investment banking. And remember I said banks are among the worst culprits when it comes to cross-business subsidizing? If you allow a bank to use the same cost of equity across the board, you can almost safely predict that over time your investment banking is going to get bigger, your commercial banking is going to get smaller, because you're not playing a fair game. You're making them all compete for the same equity capital, but saying, show me your return on equity. A bank portion, they can't come up with 18, 20, 25% return on equity because it's a safe business by itself. So you've got to be fair about assessing capital, and that's why we compute cost of equity by business. Any questions? Yes?
So you have spoken about investment banking, investment banking, but when you take deals and savings banking, except with one or two exceptions, all of them will have some kind of composition.
Not really, right? Goldman Sachs, Morgan Stanley. I mean, if you look at them, the traditional commercial banking aspect is tiny. It's almost all investment banking. It's starting to change. Now that Goldman's talking to Amazon about creating a banking business, things might get different, right? But if you look at least traditional investment banks that are publicly traded, which are mostly in the US and the UK, they tend to be almost all investment banking. I thought the question was asked, a mix of investment banking can be different in different investment banks, right? If you want to slice and dice, then you've got to do sales and trading, and if you can find enough companies in each space, you might be able to do it. Because then you'll be cross-subsidizing, because the commercial banking side is very different. We can argue about how much investment banking is broken down to other business, but this much I can predict safely. The commercial banking side is safer than anything you do in investment banking, because it is, commercial banking fundamentally is a safe business. You're saying, how come banks have runs? Because they have regulatory capital that is a relatively small percentage of deposits. Small mistakes become catastrophes. That's why you have regulatory capital requirements. So we can debate about whether to break investment banking down into parts, but commercial banking has to be kept separate from everything else. It is a different business. So 5 companies, what's the one company I haven't dealt with? Do you even remember the 6 companies I started with? I've given you 5. And that Bookscape is being like an orphan wandering in the wilderness. I haven't talked about it for a while. Remember that independent bookstore in New York City? So here's the last phase of what I want to do with bottom-up betas. One of the great advantages you get with bottom-up betas is you can now estimate the beta for a private company, a division. And there are people who've tried to do it in a different way. I'll give you one way in which people have tried to estimate betas for private companies. Why are we not able to estimate betas for private companies with a regression? Because the stock is not traded, right? So there are some people who look at accounting earnings for private companies and look at the change in earnings from period to period and regress those changes in earnings against changes in earnings on the S&P 500. So it's a regression, but using earnings instead of prices. Sounds pretty good, right? But what's the catch? What is the problem with using accounting earnings changes instead of stock price returns on your beta? How often do accountants measure earnings? Even at public companies 4 times, and at private companies often twice or once a year, right? So the first problem you're going to run into is your sample is going to have 6, 7, 8, maybe 9 observations. Incredible standard error. The second is accountants smooth out earnings. For good reasons or bad reasons. What it means is if you have a really bad year, they try to make it less worse. If you have a really good year, they try to make it less good, which means your accounting earnings are not capturing your true operating risk. So I've tried it, it's never worked for me. So to get the beta for a private company, I'm going to fall back on what I just did for Disney and Vale and Deutsche, which is to look at the businesses the companies in building. So I'll give you a little bit of history on how Bookscape ended up in my applied corporate finance book. About 20 years ago, I was sitting in my office basically doing nothing, which is what I usually do in my office. And this person walks in, and she says, I hear you teach valuation. I said, that's a mistake. I'm the marketing professor. But she said, no, I saw your name. You teach valuation. I said, okay, you got me. She said, I own it. I own this bookstore in New York City that my grandfather started, and we're facing a fight or flee decision. Her first reaction is, should you be talking to the police, maybe the FBI? She said, no, not that kind of fight or flee. She said, we've been in this great location in New York City. I had to change the name of the bookstore to kind of give her some cover. And she said, we've been there 60 years and we have a solid business, but we've never put money back in because once we got the initial lease, the bookstore has run itself. But in a few months, there's a new Barnes & Noble. At this time, Barnes & Noble was the rising threat to all bookstores. See how history passes you by quickly? There's a new Barnes & Noble opening, but 6 blocks away from us. And I have to decide. This is sounding like that movie, right? With what is it, Sally Fields and it's not the movie. It's not. There's no fun ending, no romance involved. So don't get too excited here. Okay? There's a new, and here's our choice. We can invest because if a new Barnes & Noble opens, they have couches and they have coffee shops. So we'll have to invest about $500,000 back into the bookstore, which will be the rest of my wealth. That will be the fight response. Or we can just give up the lease, and since it's such a great lease, the landlord will pay me a couple of $1 million to move away. I said, I still don't see why you're here. She said, to decide whether to invest $500,000, I have to decide what I need to make on that money. She did not use the word, but what was she asking me for? A hurdle rate, right? Basically, people don't say hurdle rate, they say other things, and you got to read behind it and say, okay, you need a hurdle rate. My first response, you run the business for 60 years without figuring out how much, and let's face it, lots of private businesses were started by accident by somebody, not by accident, but at some point in time, the good things came together, they've been running. Nobody sits and says, what's my cost of equity or cost of capital, especially if we're not putting money back. So I said, yeah, you do need a number. She said, can you help me? I said, I guess so. And she gave me like a $100 book certificate. I love books. So I said, okay, I'll be, come back in a week or so. I'll call you in a week. So after she left, I went and looked for all publicly traded book retailers. This is my updated table. But when I did this, even then, there were like 4 publicly traded books. So if I stopped at book retailers, I would have, 2 bookstores. It used to be 4 then. I said a sample size of 4 is not that much. I've got to go up and, remember the first ploy, up and down the food chain. So I brought in publishing companies. I got to a sample of 12. Then I looked at my gift certificate and it said $100. I said, this is how much work I'm willing to do for 100. Maybe if it was $10,000, I'd have kept going to like 100 companies, but 12 is good enough. And I did exactly what I did for Disney. I came up with the beta, the debt to equity, the cash. Remember how we did it for the studio business? And came up with an unlevered beta for being in the book business of 0.76. So just like Disney, I'm acting like it's a public company. I've come up with a beta for being in the business there. What's the last step? With Disney, after I got the unlevered beta for the business they were in, what's the question I asked Disney? What's your debt to equity ratio? But that debt to equity ratio was in market value terms, right? Because, and for Disney as a public company, that was easy to get. So after I got the 0.76, I thought about it. There was no market debt. So I called her and I said, do you have a target debt to equity ratio? She said, a what? It kind of answered my question. Since she didn't have a target debt to equity ratio, I said, you're in the book business. I know the debt to equity ratio for public companies in this business is 21%. And that's not by accident. They picked the debt to equity ratio because it worked for them. I gave her the same debt to equity. And when I levered up, I came up with a beta of 0.86. And I was off to the races. Risk-free rate plus beta times risk premium. The cost of equity was 7.5%. I almost called her and gave her this hurdle rate when I remembered something from my risk and return past. When I use betas to come up with the cost of equity for a public company, what am I assuming? That the marginal investor is diversified and that the rest of the risk goes away. What did she say at the start of the conversation with me? She was going to take the rest of her wealth, $500,000, and put it back into this private business, into the bookstore. She's going to be the exact opposite of a diversified investor. Right? So here's a generic question that I have for you. We all know how to come up with risk-free rate plus beta times risk premium, come up with the cost of equity. When you use that approach to come up with the cost of equity for a private business, given that the owners of private businesses tend to be over-invested, if not 100%, much of their wealth is tied up in the private business. They're not diversified. Are you going to underestimate the cost of equity or overestimate the cost of equity? You're going to underestimate, right? Because you're ignoring all that other risk that the owner is going to care about, right? So if Boeing were privately owned by you, you had a bad weekend. You've lost 10% of your value. And you don't have the benefit of diversification to help you out. So 25 years ago, I started thinking about how do you come up with the cost of equity for a private business? So I remember I was at a grouping of private company appraisers, like 500 people in the room, and I said, what do you guys do about the fact that investors are not diversified? You can't just take risk-free rate. They said, we add 10%. I said, what? They said, you take the risk-free rate plus beta times risk premium. We add 10%. We call it company-specific risk. I said, why 10%? It was here when I got here. I have no idea. Everybody does it. So I said, this doesn't work for me. I agree with you. It should be higher. But I can't just add 10% to every company's cost of equity. There must be a better way to do it. And you can tell me whether, because what I do is still not established practice. I do it because it works for me. Here's my rationale. If you're not diversified, you're exposed to not just the market risk, but the rest of the risk in the investment, right? If I could somehow tell you how much of the risk in a bookstore comes from the market and how much is firm specific, you should then be able to take your beta and adjust for the fact that you're exposed to all this other risk. Think of it as an algebra problem. The beta that I got of 0.86 captures the risk that a diversified investor, the market risk, but you're exposed to all the remaining risk. I want to bring in the rest of the risk. And the way I do this is I take your beta and I divide it by the square root of the R squared. I'm going to ask you a stupid question. What's the square root of the R squared? R, right? It's a correlation coefficient. You're saying, why do you take a square root? Because beta is a standard deviation method. It's a kind of inside the weeds thing. So listen to it, forget it, and just use the square root of the R squared after you've got this behind you, right? Beta is a standard deviation measure. R squareds go with variances. The correlation goes with standard deviation. So here's what I'm saying. 51% of the standard deviation in a typical book business comes from the market, 49%. So let's make it 50-50, nice round numbers. Roughly half the risk in a typical movie business, in a typical book company comes from market risk. And if you are diversified, that's all you care about. This lady is not going to be diversified. She's going to face that risk plus the 50% that we'd normally have thrown away. Roughly speaking, the beta that she will see in the same company will be twice as high as the beta of somebody who's diversified. I call this a total beta to reflect the fact that it captures total risk, not just market risk. I end up with a higher beta and a higher cost of equity, 12%. That's what I called her and gave her as a hurdle rate. You need to make at least 12%. And she asked me 2 questions. I knew the answer to both, but I could not think of a kind way to answer the second question. Here's the first question she asked me. Barnes & Noble, publicly traded bookstores opening 6 blocks away from me. What's their cost of equity going to be? She didn't use the word cost of equity. What rate of it? What's the answer to that? They're publicly traded, so the marginal investor is diversified. For them, I'd use a 7.5% cost of equity. I said it'll be about 7.5%. She asked me the second question. She said, if my cost of equity is 12% and their cost of equity is 7.5%, how am I going to compete with these guys in the long term? It's almost like an unfair fight, right? Because they can take projects that make 8 or 9% and create value. You look at the same project, you can't do it. What's your honest answer to that? You cannot. This is one of those things that troubles people because we're all very attached to mom and pop businesses, right? We want the owner behind the counter. There's something, romantic or whatever about the notion of owners behind the counter, they're the ones who... But here's the problem. When you own a business, you're not being very efficient about the way you take on risk. You work twice as hard as the public company managers, but you face risk you should not be facing. So over time, what's going to happen? Your private businesses and public companies in the same space, over time what will happen? The public companies will push the private businesses out. I mean, this is how Home Depot pushed out the traditional, you could have economies of scale on top, but even if you did not have economies of scale, going head to head, you can see why public companies will push out private businesses. Yeah.
It's kind of a stretch. What if Warren Buffett owns a private company?
That's a good question. When Paul Allen, for instance, owned the Portland Trail Blazers, it was part of a portfolio of investments. Then you can argue that you're a diversified investor. Private equity investors often, KKR and Blackstone might have a big position, but they're holding a portfolio. That's why if you're going into that space, you might as well treat them as public company investors because they're diversified. But when we talk about most private businesses, this is going to be the case. And I'll give you a couple of examples of how this is played out in the US. 25 years ago, if you walked into a pharmacy in the US, 90% of pharmacies in the US were privately owned. The pharmacists often owned the pharmacy, so you went in. Today you walk into a pharmacy, you look up, what do you say? CVS, Duane Reade. No, it's almost impossible if you live in the cities to actually find a privately owned pharmacy. At one point in time, every city used to have a garbage disposal business that was a private business there, usually with ties to the mafia. Over time, Browning Ferris went around the country. They rolled up these private garbage. They created a garbage disposal company. Now, this is history. The last Blockbuster store I hear is closing soon. I have to get to it really fast to see what they carry on the shelves. But the original idea behind the Blockbuster was you used to have privately owned video stores all over the country in the 70s, the 80s. Blockbuster rolled them all up to create a public company. I know it goes counter to what we'd like to see happen. But the reality is public companies will drive out private businesses, not because private businesses are inefficiently run. They're actually probably more efficiently run than public companies, but because the owners of private businesses don't have the luxury of taking the view of diversified investors. And yes?
Wouldn't your solution to your problem be to sell parts of the business?
That's an excellent question. In fact, do you see that if you own a private business, if you could sell a portion, then finish the story. What do you have to do with the cash you get from the...
Invest it back in the business?
No. Don't do that because then you've defeated the whole point. Let me give you the question again. So what do you want to do? You want to get diversified, so go buy the S&P 500 index fund with it and build it up. In fact, last time, I grew up in Chennai, which is a city in South India, and I was, the city is completely unrecognizable to me anymore. So I was walking down this busy stretch. And India, 90% of retailing is still run through very small private retail businesses. And you're wondering, how, these owners, so you can sit there and try to explain to them total beta and market beta, but they get it fundamentally, that they're overexposed. So I heard that private equity investors are now going into these small retail stores, offering the owner cash up front for 20 or 25 or 30% of the business. So it's happening at levels you don't even see yet. And these are not the KKRs and the Blackstones. They're small private equity funds that have been created. So this is going to happen across the world, whether you like it or not. Public companies are going to drive out private businesses simply because it's a better way to share risk. So, yeah, go ahead.
Why do you use market value, book value of debt?
Never ever use book debt and book equity, right? You want book debt and market equity?
Yes.
Where are you going to get market equity?
You can use some multiple...
Okay, so that's another story.
I don't know what
Yeah.
already. Let me complete my thought
Yeah.
on that.
Yeah.
Bookscape's debt will most probably be from a bank.
It's from a lease.
It's from a lease. So buying back the lease would be as good as paying,
That's kind of difficult to do, right? Buying back the lease would mean, I don't even know how that would work because it's a lease on on a property in New York. But let's say it'd been conventional debt. So
it's a commercial bank debt.
So basically, so let's assume, let me concede to you, let's assume book debt is equal to market debt. Now go on. Now what?
Yeah, then you should have used book debt. That's all what I was trying to say.
Without a denominator, I'm kind of frozen, right? I can use book debt, but if I don't have, you're right, I could use a price earnings ratio on the net income or something to come up with an estimated equity value. If it's worth the effort, you could. There's actually within Excel a way in which you can set up the iteration box. You can do in valuation of private companies. Probably not worth the effort, to be quite honest, is use a market debt to equity ratio because your estimates will be as fuzzy and as noisy as using an industry average.
But now this is a target debt to equity, not the actual.
You don't even know whether it's the actual or the target, right? Because you don't know the market equity. It could be what they're, so in a sense we don't even know until we actually value the private company. You could actually do a valuation of the private company, come up with an intrinsic value for equity and use it, right? But that's going to be a lot of work to get your cost of capital in the first place. There's a circularity here that you got to get. So when you get a chance, I'd like you to estimate a bottom-up beta for your company. You've got to figure out the businesses it's in. You've got to work out what the bottom-up beta is. It's an exercise everybody in the world should go through at least once in their lives. That's my mission. That's all 6 billion people. You've got to estimate a bottom-up beta. You can't die, right? So on your deathbed, I show up with the bottom-up beta calculation. Do it. I'm going to leave with one final question, then we can end for the session. Incidentally, I have to tell you that you might not want to know this, but now that your quiz is over, there's something else coming due on April 3rd. Do you know what that is? There's a case. I will be sending you the case after class. I wanted to wait till the quiz was over because I don't want to pile on. So you'll get the case. And you can't do the whole case yet, but you can do a big chunk of it. So I know you want to work on corporate finance during your break. That's really your end game. So for those of you who do, get that one person in your team who has nothing else to do and say, why don't you work on it? No? Offer him money or something. So last question for today is I want to bring in debt into the process. So far everything we've talked about is cost of equity. So I want to start off with a question. What is debt? Sounds like an absurd question, right? You're saying, I know the answer to this, whatever's on the balance sheet, if only it were that simple. I'm going to give you the 3 criteria I look for to classify something as debt. The first is debt gives rise to a contractual commitment. Not a promise, but a contractual commitment. When you issue equity to me, you might say, I'll pay you a dividend, and this is what you can expect, but I can't sue you if you don't. But debt gives rise to a contractual commitment. Second, that contractual payment in much of the world is tax deductible. It's usually an interest payment in much of the world. So that's almost not as required a criterion. And third, if you fail to make that contractual payment, something bad happens to you. If you're a company, you could go bankrupt, default. Contractual payment, tax deductible, loss of control if you don't make it. So you ready? I'm going to throw some items at you from an accounting balance sheet, and you tell me whether they meet the criteria for debt. Let's start easy. Corporate bonds. Clearly, coupons are contract. Yeah, that was easy. Long-term bank loan? Sure. How about a short-term bank loan? Of course. Now, that's why I've never understood people who compute cost of capital using only long-term debt. What are you telling me? If you have a 6-month loan, you don't have to pay it back? It's absurd. Any interest-bearing liability is going to be debt, short-term as well as long-term. But until 2019, there was one very big item off balance sheet that should have been treated as debt, that starting in 2019 is going to show up, but should have been treated as debt all the way through. Contractual commitment, tax deductible loss of control. What did I say Bookscape had as its debt? A lease agreement. And lease agreements run multiple years, 10 years, 20 years. So when you sign a lease agreement, have you made a contractual commitment? I hope you realize you have. It is tax deductible. And if you fail to pay it, you lose that leasehold immediately. But if you fail at a bunch of leases, guess what? You can go bankrupt. Caldor and Bradley's 2 discount retailers in the US were put into bankruptcy because they failed on a bunch of lease payments at the same time. Over the weekend, somebody sent me a news story about Tesla. Remember a couple of weeks ago, Elon Musk announced he was closing. There's nothing you can, I mean, this guy can, on the spur of a moment, we're going to close down all Tesla stores. Okay. But these stores are in malls and you've signed 10-year lease agreements. So the story was about how the landlords are saying Tesla can do whatever it wants, but we have a contractual agreement with Tesla. If they decide to break it, we're going to go after them for the lease payments. So if Elon Musk thought lease commitments were not debt, now he's got a reminder that they are debt. So when we talk about debt, that's what we're doing, and I'll close with this. This is going to be the objective on Wednesday. We're going to try to attach a cost of debt, and I'll give you what we're aiming for. We want a cost of borrowing long-term today. 2 keywords there. Long-term. Even if you have short-term debt, I'm going to take all of that and say, if you borrowed long-term, what would it cost you? Why? Because the rolled over cost of short-term debt, I'm going to assume it's going to converge on long-term, because otherwise I've given you an opening as a company to try to lower your cost of capital by going to shorter debt. And it's today. It's not the rate at which you borrowed money 2 years ago, 5 years ago, 10 years ago. It's what you can borrow money at today. So what's going to go into it? You're going to have a risk-free rate as a base, because nobody should be able to borrow less than the risk-free rate today, plus a default spread. And our entire focus in cost of debt is coming up with a default spread that is right for you as a company. So on Wednesday, we're going to go through ways of estimating the default spread, starting easy, and then moving to more and more difficult scenarios.
The answer for under-levered or over-levered firm that you want to target for equity buybacks, which one is it? So I originally thought over, but then I changed my answer to under.
How would you want to stop an under-levered firm from buying back?
Because then you want to look at which one has a higher likelihood of doing a stock buyback. So if it's under-levered, what they'll do is they'll leverage up and then do a buyback.
The right thing. You're trying to stop the wrong actions, not stop buybacks altogether. You're trying to stop the bad kind of buybacks.
Right, that is a bad buyback.
Why is it a bad
Because if it's under-levered and it has good investments, what it should do is lever up and then invest in those good investments.
You can do both.
Because the good investments generate a higher return than the buyback. You shouldn't do both.
Borrow money and take the good investments, right? You have all the capacity right before you. Take the good investments.
But you're assuming there's too many assumptions. Because let's say that your good investments are 100 million.
But let's take those 2 scenarios. Under-levered good projects, over-levered good projects. Which one is more dangerous from this?
Pretty sure it falls. It's not unchanged.
Let's take even your rationale about the projects being good projects and companies with good projects.
Right. If you look at it from more danger, then it's over-levered. If you look at
But
if you look
both
at
of them have the same.
right, but if you look at the higher probability of which one will actually do a stock buyback, that's what you want to target.
Because your stock valuation,
Your
stock price is based on
in
the
the sense if you're under-levered, you have good
I'm like
projects,
almost
you can
certain.
pull off both.
Yeah.
Buying back stock and taking the
That's
good
what I want to
profit.
tell them.
If you're over-levered, you buy back stock, you're
There's
screwed,
a block
right?
button.
Because you don't have the option of raising money. You're over-levered. There's no capacity for you to borrow money. So you used up all the equity you could have used on your project. But if you're under-levered, you can buy back stock, and you can still borrow money. You have debt capacity.
Yeah, I'm going there.
But the two are
I
not
thought regulations were supposed to stop things that have a high likelihood of happening. Although it's worse. It's
regulations
worse.
are designed to stop bad actions from happening. not things for the high.
It's in Bend.
So I don't want to stop
Oregon.
Right.
mergers from happening. I want to stop bad mergers from happening. I actually want to increase the probability of good mergers and reduce the probability of bad
Bend the
mergers.
paper.
So if there's a
Or
40%
that's
chance
fold the
of
paper.
merger,
Yeah.
I want it to be 90% for the good mergers and 10% for the bad mergers. Same thing, if you're creating a law for buybacks, you want the good buybacks to still go through. Good buybacks are buybacks
Ready raceable.
that essentially make the equity investors better off without hurting the company or the
For the record, I
lenders
don't
in
like
the
these very much.
law. So good buybacks you want to go through, but the bad buybacks you want to stop. So from that perspective, I think that even though your logic about the investments is right, you're assuming that if I do buybacks, I can't take the investment. But if I'm under-levered, I have debt capacity.
But you're assuming that you can, though. That's what I'm saying.
That's why the,
Let's say the good investment. Let's say the good investment
but
costs
in
100
the sense,
million.
I've already said it's an under-levered firm. So in a sense, the firm knows there's debt capacity,
Right.
right? So it can borrow money. So I am assuming they can borrow money because the problem states it to be under-levered. If I had not specified the leverage component, then I think you have a point. It's all about projects. You want to make sure that any company with good projects doesn't buy back stock. Berkshire Hathaway is buying back stock this year. They still have good projects. They just don't have enough good projects to cover all of their equity. So you want to make sure there's enough debt capacity to take the projects, but on top of that, if you still have cash, you can buy back stock.
But that's what I'm saying. I don't think the assumption. I didn't assume that you'd still have cash. Because that under-levered
But I'm
means
still saying, why would you pick the under-level over the over-level?
because there's a higher probability that company will actually try to buy back stock.
Yeah, you have
Because it thinks it's under-levered, so it'll actually try to implement the stock
Doing the
buyback.
right thing.
You have
If it's under-levered,
Vale,
it should be buying back stock. I don't see